Welcome to Griffonomics. Usually when we talk about a major apparel brand, the life cycle is, well, it's pretty predictable.
Oh, absolutely. It's
Uh,
almost boring. They start out niche, they catch fire with a dedicated crowd, and then they expand globally.
right. And eventually they just become part of the background of everyday life. But today, we're looking at a company that completely shattered that mold, only to find itself suddenly fighting for its very identity.
Yeah, fighting hard.
I'm talking about Lululemon, and we are not introducing them today as the invincible premium yoga pant empire that, you might have in your closet right now.
Definitely not.
We are introducing a company at a massive crossroads. Our mission for this deep dive is to execute a granular investigative report into Lululemon's fundamental transition. We want to show you exactly how this hypergrowth darling turned into a mature battleground stock.
And to do that, we have pulled together a really massive stack of sources for you.
Yeah, we're combing through their Q4 2025 earnings transcripts, dissecting the latest analyst reports, translating some incredibly dense SEC filings, and reading through some genuinely aggressive activist shareholder letters.
It is a phenomenal stack of materials. I mean, we've got massive product failures, geopolitical risk that could halt their supply chain, and a literal boardroom brawl all happening simultaneously.
Okay, let's unpack this. Let's start by laying out exactly what Lululemon looks like today, because the scale of this technical athletic powerhouse really is staggering.
It is. We are talking about an omni-channel giant operating 811 company-owned stores globally.
811 stores, and while they've expanded their reach, the foundation is still heavily anchored by their women's segment. That drives 63% of their revenue.
Right, with men's apparel becoming a key growth pillar at 24%.
And accessories, think of those everywhere belt bags you see on literally every street corner, that rounds it out at 13%.
And if you just look at the top line numbers for fiscal year 2025, the empire looks incredibly robust. They hit $11.1 billion in total revenue. Yeah, that's a 5% increase year over year. Even in their most recent Q4 2025 earnings, they delivered a technical beat on expectations, bringing in $3.64 billion globally just for that quarter.
So if you stop reading the earnings report right there, everything looks great.
It looks perfect.
But I'm looking at the breakdown here, and this is where we hit our first massive causal pivot. Because when you dig underneath that $11.1 billion umbrella, the regional data reveals a shocking bifurcation.
Yeah, it really feels like we were looking at two entirely different businesses.
It's the definition of a tale of two companies.
Exactly. That massive total revenue number is masking a profound divergence. We are looking at explosive international growth that is essentially acting as camouflage for a stagnating core business.
Let's break down those Q4 numbers to show you exactly what we mean. So globally, they brought in $3.64 billion. But the Americas, which is their absolute bedrock, making up 71% of their total revenue, that actually fell by 4%.
And the U.S. specifically was down 5.5%.
Right. But then you look across the globe, and mainland China surged 24% in Q4 alone.
It's wild. For the full year, China was up 29%.
It's a massive geographic disconnect. The best way I can think to describe it to anyone holding the stock is like looking at a beautifully painted house with a cracked foundation.
Oh, that's a great analogy.
Right, because the international expansion, the new markets, the explosive growth in China, that's the fresh paint and the new landscaping, it looks fantastic from the curb.
But if the core North American market, the very foundation holding up 71% of your entire revenue structure, if that is actively shrinking, the whole building is at risk.
Yeah.
What's fascinating here is Lululemon's strategic response to this foundational crack. They know North America is stalling.
Yeah, they have to.
So they are leaning even harder into that international momentum to essentially buy themselves time to fix the domestic market. In 2026, they are planning a record international expansion into 6 new markets, including Greece and India.
And crucially, they're doing this via franchise models.
Yeah, which is a big shift.
Wait, let me push back on that for a second. Franchise models. For Lululemon, I mean, the whole appeal of the brand has always been this incredibly controlled, premium, high-touch retail experience.
Exactly.
If you suddenly start franchising out stores in Greece and India, doesn't that risk totally diluting the brand? How do you control the guest experience from half a world away when a third-party operator is running the shop?
That is the exact risk analysts are flagging right now. Franchising means giving up a significant degree of control over the customer experience.
So why do it?
Capital efficiency. A franchise model allows them to plant flags in new countries rapidly without spending their own cash to build out the stores.
Ah, I see.
They need to preserve their cash flow, to fund the domestic repair job. So they're willing to accept the brand dilution risk abroad to generate high-margin licensing revenue right now.
Which brings us to the financial realities of that domestic repair job. Because a shrinking North American market didn't just hurt their pride, it directly caused a financial bleed in FY 2025.
Oh, definitely. This wasn't just a loss of cultural momentum. It was a devastating hit to the bottom line.
Right. The Q4 numbers revealed some brutal realities for their profitability.
Brutal is the word. We saw gross margins compressed by a massive 550 basis points, dropping down to 54.9%.
Let me stop you right there for anyone who doesn't live inside a financial terminal every day. 550 basis points basically means a 5.5% drop in their profit margin, right?
That's exactly right.
For a company selling $120 leggings, losing 5.5 cents on every single dollar to inefficiencies or costs, that is an absolute bloodbath.
It is an earthquake for a premium brand. I mean, Lululemon has historically traded at a premium valuation, specifically because their margins were considered untouchable.
And looking at our sources, a huge driver of that 5.5% margin erosion wasn't just fewer people buying clothes, it was a massive regulatory headwind. We need to talk about the Tariff Armageddon.
Right. This is where external political forces really punish them. Historically, Lululemon utilized a U.S. trade loophole known as the de minimis duty-free exemption.
Right. To understand this, imagine a toll booth on a highway. If you drive a massive commercial truck through, you pay a huge toll.
But the de minimis rule basically said that if a package is small enough and under a certain dollar value, it can slide right under the toll gate for free.
So Lululemon was fulfilling U.S. e-commerce orders from massive distribution centers just across the border in Canada, allowing them to ship millions of individual products into the U.S. completely tax-free.
But the U.S. government caught on and completely eliminated that de minimis exemption for apparel.
The toll gate came crashing down.
Exactly. Every single one of those packages is now getting hit with baseline tariffs. The financial impact was immediate and severe.
Yeah, the loss of that exemption caused a $275 million hit to their gross profit in 2025.
And it's not a one-time problem.
Yeah.
Looking ahead to 2026, they're projecting a massive $380 million gross tariff hit.
That is $380 million just vanishing into supply chain logistics and federal taxes. And because of this, their FY26 revenue guidance was incredibly sluggish, just 2% to 4% growth, which deeply disappointed Wall Street.
The market reaction was swift, sending the stock tumbling.
So what does this all mean? I look at this and I'm a bit confused by the market panic, honestly. If you look at their balance sheet, it is pristine.
It really is.
They are sitting on $1.8 billion in cash. They have virtually no interest-bearing debt. So why is the market treating a cash-rich, debt-free company with a booming business in China like a retailer in terminal decline?
Because the market isn't just looking at the cash they hold today. It's looking at the systemic vulnerabilities threatening their ability to generate cash tomorrow.
Beyond the tariffs.
Right. Beyond the tariffs, there is massive geopolitical and supply chain exposure. According to their SEC filings, 47% of their products are manufactured by just 5 vendors.
That's a huge bottleneck.
And even more concerning, a staggering 34% of the highly specialized technical fabric used in their products originates from Taiwan.
Wait, okay, we need to pause on that. 34% from Taiwan.
Yep.
So if there is any disruption in the South China Sea, any military escalation, or even severe maritime trade embargoes, more than a third of Lululemon's core materials are instantly cut off.
Instantly.
But surely they could just move that production somewhere else, right? Bring it to Mexico or South America?
Not easily, and certainly not quickly. We're talking about basic cotton t-shirts here.
Wow.
Lululemon's fabrics require highly specialized knitting machines.
Right, and proprietary chemical treatments for sweat wicking.
Exactly. And high-filament synthetic yarns. Rebuilding that exact manufacturing infrastructure in a new hemisphere takes years of capital investment and testing.
So that massive single point of failure in Taiwan is terrifying institutional investors.
Terrifying them.
But as severe as tariffs and geopolitical tensions in the South China Sea are, those are external threats. What's truly wild about the sources we are looking at is that Lululemon's biggest threat in North America has actually been entirely internal.
Yeah, they have been inflicting wounds on themselves. We are talking about the quality crisis.
Exactly. Lululemon built its entire empire on technical superiority. You paid top dollar because the gear never failed.
But recently, they've suffered a string of highly embarrassing, botched product launches.
We are talking about the Breeze Through, the Get Low, and the Heart Scatter collections.
These weren't just mild misses on color trends either.
No, these lines faced severe consumer backlash and had to be completely pulled from shelves because of incredibly sheer, see-through fabrics and bizarre, unflattering fits.
It gave longtime investors terrifying flashbacks to the infamous 2013 Luan pants recall.
Oh man, yeah.
When your entire brand identity is built on being the premium, flawless technical option, releasing sheer yoga pants isn't just a mistake. It is a catastrophic failure of your core promise.
And because they had these massive failures, they were left with a ton of inventory nobody wanted, which forced Lululemon into a corner they usually avoid.
The markdown trap.
The markdown trap. To clear out this unappealing inventory, they had to rely heavily on discounting, which, mechanically speaking, is poison for a premium brand.
It really is.
Think about it like a luxury car dealership running a cheesy buy one, get one free weekend blowout sale. Sure, it clears the inventory off the lot, but it completely destroys the premium aura of the brand.
You essentially train your customer to never buy at full price again.
Exactly. And worse, while you are discounting bad products, you drive your high-value core guests straight into the arms of fierce competitors. Brands like Alo Yoga and Vori are aggressively capturing that aesthetic-focused demographic, while Lululemon is busy running clearance sales on sheer leggings.
Recognizing this existential threat, the leadership has had to pivot hard. Interim co-CEOs Megan Frank and Andre Maestrini have rolled out a 2026 action plan specifically designed to reclaim that technical crown and wean the North American consumer completely off discounts.
I read through this 2026 action plan, and I need you to translate some of the corporate speak for me.
Sure.
They say the core focus is on innovation and speed, specifically slashing their product development cycles from 18 months down to 12 months using AI. Hold on. How does an algorithm actually make a physical pair of pants faster? Are robots suddenly sewing these garments?
It's a great question.
No.
No, it's not about robot sewing machines. It's about eliminating the friction in the design phase.
Okay.
Historically, a designer draws a concept. They ship a physical sample from Asia, they try it on a fit model, they make tweaks, ship another physical sample.
That takes months.
Exactly. Now, they're using AI predictive modeling and digital twin virtual prototyping. They can simulate how a fabric will drape and stretch in a computer before ever cutting cloth.
Oh.
This allows them to skip multiple rounds of physical sampling, transitioning into what they call a chase-ready operator.
Ah, okay. That makes sense. Speed is critical because if Alo Yoga drops a new pastel colorway that goes incredibly viral on social media, Lululemon can't afford to take 18 months to get a competing product on the shelf.
The trend will be dead by then.
Precisely. And that ties into their second pillar, which is a massive pivot toward newness.
Right. They are intentionally pushing their new style penetration, which is the percentage of the store assortment that is entirely new designs, from 23% in 2025 up to a highly aggressive 35% in 2026.
But importantly, they aren't just pumping out new colors. They are heavily leaning back into hardcore textile science to remind people why they cost more.
Yes, and this is where they hope to fundamentally differentiate from the purely aesthetic lifestyle brands. They are launching major patented textile breakthroughs.
Like the Show Zero tech.
Exactly. Show Zero is a yarn innovation that actually changes how light interacts with the surface of the fabric to completely conceal heavy sweat marks.
That is so cool.
It can be completely drenched, and the fabric looks totally dry. They debuted it with professional tennis star Frances Tiafoe.
See, that is a fantastic functional selling point.
They also launched Unrestricted Power, a new apparel line specifically engineered for heavy weightlifting. It uses a proprietary fabric called PowerLu, which features a high filament count yarn designed to provide extreme multi-directional stretch and support without riding up during deep squats.
And they developed this directly alongside 7-time Formula One champion Lewis Hamilton.
They did.
So they're essentially drawing a line in the sand saying, look, you can wear the other guys to go get iced coffee, but when you are actually sweating, lifting, and performing, you need our engineering.
Exactly.
But here's the massive catch. Executing a fundamental supply chain overhaul, rolling out untested AI algorithms, and launching patented new textiles requires an incredibly steady hand at the wheel. Which brings us directly to the chaotic reality of Lululemon's current boardroom.
It is arguably the most dramatic, high-stakes subplot of this entire transition.
In January 2026, CEO Calvin McDonald abruptly resigned. Now, the official PR spin was that it was a mutual decision at the end of a 5-year strategic plan.
Right.
But reading between the lines of these analyst reports, it is universally agreed he was ousted due to the North American stagnation and those severe product quality failures.
Leaving the company to be run by the interim co-CEOs, Megan Frank and Andre Maestrini, while the board searches for a permanent replacement. But that executive search is happening under intense, hostile fire from multiple directions.
Yes, it is. Chip Wilson, the original highly controversial founder of Lululemon, who was actually forced out of the company back in 2013, had launched a vicious, hostile proxy campaign.
He really has.
He literally created a public website called creativityfirstlulu.com to wage war on the current board of directors. Wilson's core argument is that there is a massive disconnect between the creative engine of the company and the board's strategic oversight.
He claims the current board is entirely comprised of finance and operations people, completely devoid of brand and marketing skills, and therefore completely unfit to choose the next CEO.
Wilson is not just complaining loudly, he has a very specific set of actionable demands. He is pushing to immediately declassify the board.
Meaning all directors would lose their multi-year terms and have to stand for election every single year.
Exactly. He wants to install 3 independent creative experts of his own choosing. Mark Morer, the former co-CEO of the running shoe brand On, Laura Gentile, a former chief marketing officer at ESPN, and Eric Hirschberg, the former CEO of Activision.
Wait, Activision, the video game publisher.
Yes. Wilson believes the future of apparel is digital storytelling and community engagement, which is exactly what gaming and media executives excel at. Finally, he wants to mandate the creation of a brand product committee to legally force the board to focus on creative output rather than just spreadsheets.
But Wilson isn't the only shark in the water here. Elliott Management, which is a massive, notoriously ruthless activist hedge fund, quietly built a $1 billion stake in Lululemon.
And from our sources, their goal is almost the exact opposite of Wilson's.
Right. They don't want more money spent on creative storytelling. They are pushing for strict, ruthless operational discipline and cost-cutting to fix that 5.5% margin erosion.
If we connect this to the bigger picture, and it's vital, we state clearly for you, the listener, that we aren't taking sides in this proxy battle.
No, not at all.
We are impartially reporting the facts of the dispute from the SEC filings and letters, but it is absolutely crucial for you to see how this power struggle between creative visionaries, represented by Wilson, and operational veterans, represented by Elliott Management and the current board, is defining the company's future.
The current board is defending its position by bringing in its own heavy hitters, recently adding Chip Bergh, the former CEO of Levi's, to prove they have brand turnaround expertise.
The tension is about what Lululemon fundamentally is. Is it an art-driven lifestyle brand or a metric-driven apparel manufacturer?
And that deep philosophical tension is perfectly crystallized when you try to figure out what this company's stock is actually worth today.
Yeah, synthesizing everything we've unpacked, the bifurcated global sales masking a North American decline, the $380 million tariff hit, the AI-driven supply chain overhaul, and this brutal multi-front boardroom brawl, we have to ask the ultimate question.
What is the final verdict here?
If you are looking at your portfolio today, are we looking at a classic value trap or a generational buying opportunity?
Let's lay out the bear case first. The argument that this is a value trap. The near-term headwinds are brutal and unavoidable. Earnings are actively contracting right now due to that massive $380 million tariff hit.
There is a leadership vacuum at the very top of the company during a critical transition.
And most importantly, winning back the North American consumer from fast-moving brands like Alo and Vori is going to be incredibly difficult if Lululemon refuses to rely on the brand-damaging markdowns that have propped up their sales volume over the last year.
To the bears, the cracked foundation is simply too deep to fix quickly.
But then there is the bull case, the deep value argument. Let me translate some of the finance jargon from these analyst reports.
Please do.
They argue the stock has been beaten down so hard that it is now historically cheap, trading at roughly 11 to 13 times earnings.
For context, for a company that used to trade at 40 or 50 times its earnings because of its massive growth potential, 11 times means the market is pricing it like a dying legacy mall retailer, not a global powerhouse.
Exactly. They have a true fortress balance sheet with nearly $1.8 billion in cash and no debt. And because the stock price has fallen so far, their free cash flow yield has spiked to a very attractive 5.4%.
Can you explain that yield simply for us?
Certainly. Free cash flow is the actual cash a company has left over after paying all its operational bills and making its necessary investments.
Okay.
If you divide that cash by the total value of the company, you get the yield. A 5.4% free cash flow yield means that even if Lululemon doesn't grow another inch, the business is generating a 5.4% cash return on its value every single year.
It's a massive margin of safety.
Add in the fact that their international business is thriving, growing nearly 30% in China, and bulls argue it proves the Lululemon brand still wields immense global cultural power.
Which is exactly why, when you aggregate all the institutional analysis across our sources, the consensus strategic outlook rates Lululemon right now as a high volatility hold.
The underlying financial value is undeniable, but the execution risks over the next 12 to 18 months are exceptionally high.
Here's where it gets really interesting. I want you to step back from the PE ratios and the tariff projections for a second and consider a totally different contradiction we didn't explicitly cover in the financial breakdown.
What's that?
The resale and sustainability paradox. Look at what they're trying to do. To fight off competitors, Lululemon is using AI to drastically speed up their supply chain, pushing 35% entirely new styles every 12 months to chase viral microtrends.
Right.
But at the same time, their core demographic, the affluent, yoga-practicing consumer, is increasingly focused on sustainability, anti-consumption, and buying investment pieces that last forever.
Oh, that's a huge conflict.
So the question I want you to mull over is this. If Lululemon successfully engineers the absolute highest quality, longest-lasting athletic wear on the planet, how do they justify requiring their consumers to buy 35% newness every year without looking like a glorified, high-priced fast fashion brand?
That's tough.
Well,
Can you be a champion of mindful, enduring quality while simultaneously operating a trend-chasing, AI-driven supply chain?
it is a profound contradiction between the science of scaling a business and the psychology of the modern consumer. And whichever way they choose to solve that paradox is going to dictate not just what you wear to the gym, but how the entire athleisure industry operates for the next decade. That's our deep dive on the Lululemon transition. Risk defined, portfolio protected,